Good morning, everybody. I am going to do another walkthrough video, but this time it's not going to be a stock trading tutorial. It's going to be an investing video, and I'm going to kill two birds with one stone because I'm going to make my TikTok video at the same time that I'm making this more detailed walkthrough. So I've been trading stocks. For those who don't know me, my name is Kenneth, and I've been trading stocks for the last 13 years and investing since I was a teenager, so somewhere around 20 years. Not a heavy full-time investor as a teenager, although I wish I was, because then I'd probably be retired by now. But just casually investing in stuff, like when I would hear something, I loved McDonald's when I was a little kid, so I would say like, hey mom, why don't, or World Wrestling Entertainment when I was a kid. I was a big wrestling fan, so I got WWE stock, Apple when I graduated high school, just from noticing what was popular. And that's how I kind of shaped my investing. Now, if you don't know, I have 200,000 followers on TikTok, and I teach them how to trade and invest. And one of my new things that I've been doing is this kind of walkthrough video where I walk through all the most important things that I consider as a long-term investor before I make an investment. And people will shout out and like, do this one, do that one. So we're going to do this one today, NVIDIA. Everyone knows this one. They're a chip manufacturer, semiconductors, equipment, blah, blah, blah. And I'm going to also be making my TikTok video, like I said. So if you see me doing this, you know I'm on the dry erase board. So this is my homepage on TD Ameritrade, and it's the first place I go. I go to 3 different websites: TD Ameritrade, Seeking Alpha, and Marketwatch, and all for different reasons. I get different things from all of them. Although a lot of this information is all on the same place, there are some things that I like specifically about each one of these. Actually, I'll make the TikTok video later because it's going to be too distracting. The first thing I look at is the price to see if I can afford it. Second thing I look at is the market cap. This just tells me not only how much the company is worth based on their shares, the price basically of all of their shares total on the market. So you say 2.5 billion shares times $131 equals 326.9 billion. It's a good metric. It just shows me the size of the company, how big they are. The second thing I like to do is glance at the shares outstanding, 2.5 billion. The third thing I like to do is I like to come over here to the P to E ratio. This shows you what the price compared to the earnings are. So the price per share compared to the earnings. Generally, the lower the number, the better. But you'll see with companies like Tesla, they have a very high price to earnings, or they'll call it, you'll sometimes hear them refer to it as the multiple. Tesla, for example, has a really high multiple, but people don't care. In other words, what they're saying is, yes, on paper it looks overvalued, right? But I'm willing to pay more because I believe long-term this company will deliver, whatever the company is. Other times, though, it can be a sign of trouble, like, wow, this stock is really overvalued. I don't want to touch this thing. It's trading at too high of a multiple. The third thing I do, and we're going to go back to the P/E ratio in a second, but the third thing I do is glance down here at the dividend. NVIDIA pays one. It's bupkis, basically. I always like to see how many, what the percentage of the shares outstanding are held by institutions, not just hedge funds, but like retirement accounts, pensions, and stuff like that. 63% of the shares are held by institutions. That tells you, number one, that a lot of big institutions really like this stock, but also keep in mind that if something is to change with this company, and these institutions start selling their shares, because they have such a large stake in these companies, they can really bring the price down. So the second thing I like to do is I like to click over here where it says valuation, because what I like to do when it goes to the P to E ratio is I like to compare it to the industry standard. Okay, so now we're on the valuation page, and I like this about TD Ameritrade because they'll break down the whole valuation of the company, and they'll explain to you, based on all this data, price to earnings, price to sales, price to book, and PEG ratio, if the company is overvalued or undervalued. And it'll usually say at the end, therefore NVIDIA seems expensive, and they go on to explain, why. You can also see here that the price to earnings ratio of NVIDIA is 39 times, whereas the industry standard is 15 times earnings. So compared to the industry, NVIDIA is overvalued. Might be of concern to you. might not, because of like what we said earlier. So now I'm going to jump over to Marketwatch. All right, so we're at Marketwatch now. Still on NVIDIA's profile. And you can see here that they have a lot of the same basic information over here. They have their profile, their charts. But what I like about Marketwatch more than any other is the way they break down their financials page. Personal preference, this is just where I like to go. So first thing we're going to look at here is under their income statement tab, I want to see sales and revenue, or sales and revenue. What I'm looking at is I want to find companies that are growing. So you can see here, we started 2018 and we go to 2022. They were making $9 billion a year in 2018, and now they're making almost $27 billion. That's a huge jump. That's a huge increase in revenue. Obviously, as an investor, you love to see it. The next thing I like to do is scroll down just a little bit to this tab right here that says net income. It shows you all the money that's left over after they've paid their expenses, taxes, costs of running the business, etc. Obviously, this is a number you want to see going up as well, and you can see here that it does in 2018, $3 billion, in 2022, almost $10 billion. That's great. Next thing I want to do is I scroll back up and I click on balance sheet. There's so much good stuff here to look at when you're making a decision, but these are the ones that I look at. If you look at different things, please let me know in the comments below. Tell me what you look at and why. I like to see the total current assets. In other words, like how much is the company, what do they have in assets that they own? And you can see here they were at 11 billion in 2018 and now 44 billion. So everything so far is looking really good. The next thing I like to do is I like to look at their long-term debt, and it has also grown, which is kind of the standard with tech companies. You don't like to see debt going up, but as long as everything else is also going up, right? So if I'm looking at what we looked at so far, if revenues are going down, if net income is going down, if the debt is going up, these are all things that are concerning to me. But as long as everything's going up together, it's less concerning. Also, tech companies tend to go into a lot of debt. And then I like to go to cash flow. I look at two things. Net operating cash flow basically tells you that they have enough cash for their daily, day-to-day operations, including, like paying for the cost of running their business daily. You want to see this go up, and sure enough, it has. 3.5 billion in 2018, and just pretty constantly growing every year up until this year with 9 billion. The last thing I like to look at is free cash flow. This is basically all the cash that they have left over after they spent everything on their operations. This is important. It shows you that they have good fundamentals, good, strong financial kind of like backing. And you can see here that it's grown as well. 2 billion all the way up to 8 billion. So now that I've looked through everything, I'm feeling very confident in my investment. Yeah, their debt's a little high, but they're making tons of money. They have billions in cash. They're growing. Their revenues are growing. And the last website that I like to go to is Seeking Alpha. And I like, I'm reading the jobs. I'm reading the jobs report. Maybe I'll make a TikTok about that when I'm done with this video. The last thing I like to do is I like to come on to Seeking Alpha, and I look at a couple different things here as well. If it's a company that pays a dividend, I like to click over here on Dividend tab, and I like to look at the dividend safety, the dividend growth, the yield, and all that stuff. Obviously, they rank it here, and they say that yes, even though they do pay a dividend, remember it's whoops, didn't mean to do that. It's pretty garbage. It's not that great of a dividend. You're not buying the stock for the dividend, but they are showing you that it's really safe. Remember, every stock is down this year, so the fact that they're down 36% doesn't scare me. In fact, I see it as an incentive, especially after we just went over all their financials. But I like to go 5-year. Look at that growth, 5-year growth, 183% growth in the last 5 years. 10 years, 4,000%. Now look, just because it grew 4,000% over the last 10 years doesn't mean it's going to grow 4,000% over the next 10 years. It just gives you an idea that this is a very high growth stock, which is why they have debt, and it's why they have a lousy dividend, right? Because you're not paying, people who are looking for a 4% dividend, who gives a shit when you get 4,000% growth in 10 years? The other thing I like to do with this website is they have these factor grades here. And it's really interesting. You can comb through it if you're really bored. You click on all these different tabs and it'll tell you why they're valuing these stocks at certain grades. And it changes. Every month, every 3 months or so, it seems to change. So the grades can get better, or as you can see here, they can get worse. They have different rating grades that they show you. And if you go back to the summary page, the last thing I like to do before I make an investment is I like to read a variety of these reviews. I'm not looking for confirmation bias. I'm not only reading the ones that say buy, strong buy. I'm looking for the ones that say sell. I'm looking for the ones that say hold. I want to read them all, and I want to have a real understanding of why, in some cases, people who are smarter than me, I know a lot of people can just submit whatever they want to Seeking Alpha, but some people, you can tell from what you read, some people are smarter than me, and I want to read. I want to know exactly why this guy says, get rid of it, don't buy it, sell it. I want to know exactly why this person says, hold it, and I want to know why these people are saying, buy it. I look at all these things. I consider all this stuff. I also consider the fact that a lot of these hold articles and sell articles are happening because markets are down right now, but I'm a long-term investor. So if I see, well, they're worried about a short-term thing right now, and that's why I have it as a hold, in my opinion, if it's a company I want to buy, not just this, but any company, I can take that short-term sell or that short-term hold, and it becomes, in my opinion, a buy, because I'm not thinking about the next couple of months. I'm thinking about buying the stock for the next decade. So if you thought this video was helpful, please hit the follow, please hit the subscribe, find me on TikTok if you want. Thanks for watching, and have a good day.